Hey everyone, if you got value out of this, please like, share, subscribe, and comment to help us with the algorithm so we can find more people like yourself that are trying to find faith in the financial services industry once again. Alrighty. Hey guys, I appreciate you guys getting on. We normally just jump straight into getting you as much value as possible, but I'm really excited today. I don't get excited very often. I got a guy here, Guy Baker. He's been in the industry for a long time. I'll let him tell you how long. Guy, if you can just introduce yourself, give me some credentials if you want to, and kind of what have you accomplished over the last couple decades?
Well, it's been more than a couple decades. I think I'm in the 58th year
Oof.
of being in the insurance business. I started when I was in college. And, as is the case with anything, if you do the same thing over and over again for a long period of time, you're going to get some results. I joined Million Dollar Roundtable, which I would encourage, anybody to find out about because it's a great source of knowledge, education, experience, and I've been a member of that for 53 years, and I was able to qualify as one of the top qualifiers for the roundtable, which puts me in the top 1% of all insurance agents in the world. And I served as president of it, actually. But that aside, I think probably what your listeners are most interested in is maybe what gives me credibility to be able to talk about the subject of insurance. Okay. And so I have 3 master's degrees, a PhD, and I've got every designation that the industry offers. So from that standpoint, there's not much that takes place in the industry that I haven't either experienced firsthand or taught or certainly learned. So that's my background. And I guess really, Dustin, what your listeners are most interested in from what you've said is why life insurance and which life insurance product is the best product. So having maybe set the stage with that as the question, it's easy to talk about why life insurance. I just had a 25-year-old grandson-in-law have a major motorcycle crash. He's married with 3 kids, and fortunately he survived. But had he not survived, where's their income going to come from? His wife works, but she doesn't earn enough to be able to support the family. So insurance for protection is a major tool, and one of the reasons why every young family ought to think about having a couple of $1 million worth of insurance. It's so inexpensive as term insurance. Why not get it? But then that brings up the whole question of, is term the only way to go? So I guess I would like to start that part of the conversation, this part, with a provocative statement, which is all life insurance, whether it's whole life, universal life, is term insurance. And the reason that I say that is because it's built on a mortality chassis. So what's a mortality chassis? Well, a mortality chassis is the curve that the insurance actuaries use in order to be able to determine the price of insurance. So, think about it. If you are 25 and you buy life insurance, let's say you buy $1 million worth of insurance, it's probably going to cost, $50, $75 a month, something like that. But if you're 35, now, that's 10 years further down the line, it's going to go up from, say, $75 a month to $100 a month. And if you're 55, it's probably going to be $200 or $250 a month. And if you're 75, if you can even qualify, it's probably going to be $1,000 a month or $900 a month or something like that. So the price of insurance gets more and more expensive the longer you live. And as a result of that, what happened in the insurance industry, and a lot of people don't know this, is it went bankrupt basically in the middle 1800s. The only type of insurance was term insurance, and the only people who kept the insurance were people who were sick, because they knew that if they paid the premium, the insurance policy would pay off. But if they were healthy, the cost of insurance got so great they couldn't afford it, and so they just let it go. So if you owned an insurance company and the only people who were retaining the policies were the ones who were sick and are going to die sooner than you expected, what's going to happen to your company?
Going under.
So yeah, it's going to go under. So if you look at all the major insurance companies, John Hancock, Northwestern Mutual, Mass Mutual, Pacific Life, all those companies, they all have establishment dates of 1846, 1850, 1855. Well, they existed before that, but they had to reorganize and start over because of that problem that I just mentioned. So what happened was the officers went to the actuaries and they said, come up with a solution. So they got their abacuses out because they didn't have computers then, right? And they went into the dark room with the mushrooms and they came back out and they said, okay, we've got it. We've got the answer. And the answer was permanent insurance, cash value. I call it the box. And in fact, I wrote a book on the box. And, if any of your listeners are interested in understanding and learning the mathematics of life insurance, that, through you, they can get this if they're interested. But anyway, so the box, the cash values, is the way the actuaries solve the problem. And essentially what they said was put in a little bit extra in the early years so that the compound interest can pay the mortality costs in the later years. Well, that made a lot of logical sense. The problem with that is that a lot of the critics look at that and they say, well, I can do better with my money. Well, that may be true. Maybe you can. After all, the insurance companies are very conservative and they have to protect all of the policyholders. So they're not going to get wild and crazy with their investments, right? And so maybe you can take that money and do better with it. Although in my experience, and like I said, 58 years, I haven't seen anybody do it, but be that as it may, by putting it into the box, you're compounding that money tax-free, and that tax-free compounding then is what's going to create a surplus of capital that can then be used to pay the mortality costs when you're 75, 80, 85 years old. And I will tell you, Dustin, in my experience, I've paid a lot of death claims through the years now. Didn't used to, but I do now. I've never had one widow return a check.
No.
They're not going to return the check. They want that money. They need that money. It's going to pay bills. It's going to pay off debts. It's going to transfer assets between generations. It's going to fund estate taxes. It's going to fund the buy-sell between two business owners or three business owners. Insurance has a lot of purposes when it turns to cash. And, as we've said many years in the $1 Million Roundtable, when somebody dies, everybody walks in grieving and sad and offering condolences. We're the only one that walks in with money.
Right.
And when we walk in with money, people are really happy to see us, I can tell you. So, I'll tell you just one story. And I'm thinking of a big farm family, and, a number of the patriarchs now have died. And they've come back and told me that if it weren't for the life insurance proceeds, they would have lost the farm. And here they were very wealthy. They owned, a lot of acreage. And yet it was the life insurance that saved the farm because of the way their money was tied up and their lines of credit were tied up and they didn't have any liquidity. And, there's all sorts of reasons why life insurance proceeds are valuable. So the question is the life insurance going to be there when you die? And if you buy term insurance, less, according to LIMRA, which is the Life Insurance Management Research Association or something like that, less than 1% of all life insurance policies ever pay off in a claim as term insurance. Mm-hmm. Yet virtually 100% of all permanent insurance does. So, which would you rather buy? Something where you're going to waste your money and you're never going to get a claim, or something where you're going to pay a little bit more for it, but know it's going to be there to take care of your family and to meet the needs that you purchased it for? So that, that's the big question, and each person has to answer that for themselves. So let's deal with what life insurance really is from the standpoint of somebody who's wealthy, because I've heard many times over the years, I don't need life insurance. I've got a lot of money, and maybe that's true. Maybe you have more more money than you need to fund the problems that life insurance might solve for you. But the cash values, the box that I was talking about, is an alternative asset class. And what that means is that virtually nobody, in fact, what happens usually with people who are very wealthy, the older they get, the more conservative they get, and the lower return they're willing to accept on their money because they don't want to lose it. It's a lot harder to keep it than it is to make it in many cases. So if you've got $1 million, $2 million, $100,000, doesn't matter what it is, in cash values, and that cash values is growing at 4 or 5% a year tax-free, what's the equivalent return in a 45% tax bracket? It's 7 or 8% probably, right? You have money in a life insurance policy that you can access at any time, growing tax-free. And as a result of it growing tax-free, it becomes an alternative source of capital for buying real estate, paying medical costs, like I say, funding buy-sell agreements between business owners. I mean, who can't figure out how to use money if they need it? So right. The cash values is a source of money as a last resort, because you don't want to touch tax-free money if you can avoid it. But if you need it, it's there. And so as an alternate asset class, most diversified portfolios, and Dustin, as you know, we manage money. We manage almost $400 million for clients. All those portfolios are diversified. All those portfolios have bonds, mostly treasuries, government securities, and most of those are earning 3, 4, 5% today. They were earning 2 and 1% here not too long ago. Okay, and if you've got cash values in a life insurance policy, $1 million, $500,000, earning 4 or 5% tax-free, that's just like having a bond in your portfolio. So it actually frees up some of your frozen money that you're holding on to protect your overall investment to be able to do other things with it. So this argument that I want to buy term and invest the difference, while theoretically you can make an argument that makes sense, practically it doesn't make sense. And when you think of life insurance as an alternate asset class where you're growing money tax-free within your portfolio, it really doesn't make any sense, because you don't have mark-to-market, you don't have to worry about interest rate risks, you've got the stability and the guarantees of the insurance company backing you up. Now, having said that, are there ways to be able to invest money in the box, the cash values in the box, more aggressively than just accepting the 4 or 5% return that the insurance company offers? And the answer is yes. There are a number of different products out there that give you the ability to invest in the stock market and have no downside risk. So think about that. If you had a guaranteed account that protected your money on the downside, and you could participate in the upside in the market to the tune of 8, 10, 12% compounding over a long period of time, do that tax-free with no downside risk, what's wrong with that? And doesn't that beat buy term and invest the difference? I think it does. Now, there's a lot of people that say, well, index universal life, that's a phony program. It doesn't really work. There's no results on it. The fact of the matter is that product's been around a long time, and it's made substantial returns over periods of time when the market's up. Now, when the market's down, you're not going to get very much, and you've got to pay those expenses. But when the market's up, it more than makes up for those periods of time when you weren't able to get much in the way of crediting, if anything at all. Take 2008, for instance, the market goes down 35, 40%. How much did your IUL cash surrender values go down that year? 0, nothing. And when the market went back up 35% the next year, your cash values went up 12%, 14%, depends on the product and what the various parameters are for it. So, life insurance is a great product, and it can be used in a number of different ways. And as I said, it fits a number of different, financial goals and objectives, just depending on, how you want to design it. So
For sure.
I've rattled on here, Dustin. Do you have any questions that you hear a lot from your listeners?
Oh, for sure. The bad thing about social media is you can find anything. You can back up your thoughts, your processes. You can get the confirmation bias that you want. So there's a couple people that say that term insurance is the only way. You talked about that. Term insurance is really basic. It's a 10, 15, 20, 30-year product that if you pay the premiums and you die, it pays. But if you don't pay the premiums or you outlive it, it doesn't pay. So you're kind of renting your insurance is what we call it. And then owning your insurance in the whole life, the universal life realm. A lot of people are using that argument that you said that IUL is kind of a phony. It's only been around for 25 years. Whole life products have been around 250 years. Some people say, which it hasn't. Now that you've kind of brought that to my attention, maybe 200 years, about 175. So the biggest argument that we're all facing is whole life versus indexed universal life. And people are saying that one is greater than the other. We sell it all. We sell term, we sell whole life, we sell index, we even do VULs. But you just tell me a little bit about your experiences with whole life, universal life, when it made the most sense. If you have examples, anything like that, that would be great.
Sure. So having started back in the late 60s, the only product that I had to sell besides term insurance was whole life. So I learned whole life and loved whole life. And whole life was really the only product that I had available other than term insurance for 25 years. So don't misunderstand anything that I'm saying right now to say that I don't like whole life, that I don't think whole life is a good product, because I do. Now, what is whole life? Well, whole life is basically an endowment, let's say at age 100. What's an endowment? Well, it means that the cash surrender values, which is a product of how much premium you put in plus how much interest is earned, is going to equal the face amount of the policy at age 100. So if you buy $1 million policy and you pay your premium every year, the guaranteed cash values plus the interest that they're going to credit to that policy is going to equal $1 million at age 100. Now, people will say, well, yeah, but what about the dividends? You know, if the product earns more than the guaranteed rate, what do you do with the dividends? Well, the dividends can reduce the amount of premiums that you put into it, or it can be added on top of the policy using various dividend options. And you can increase the amount of the death benefit, and you can increase the amount of the cash value. So it's an excellent product, and nobody would that knows anything about the two types of products should ever say whole life is a bad product, because it's not at all. Now, let's go back to the architecture. The architecture is a premium plus a guaranteed interest rate is going to equal $1 million at age 100. A universal life product, forget IUL for a second, a universal life product has exactly the same math. So let that sink into your audience. It's exactly the same math, okay? And I had a very close friend who actually was one of the developers of universal life back in the early 70s sit down with me and educate me on the differences between universal life and whole life. And that's where we started the conversation. He said, Guy, I want you to know there is absolutely actuarially no difference between these products, plus or minus a little bit because of, expense loads and stuff like that. But for the most part, the architecture is exactly the same. So if the architecture is exactly the same between universal life and whole life, then what is the difference? And the difference is how you set the premium. With whole life, you set the premium on the guaranteed interest rate, which let's say is 2.5% or 3%. On universal life, you set the premium at whatever the crediting rate is, which let's say that's 5%. So if I have a premium in whole life at 2.5%, and I have a premium in universal life at 5%, well, how much greater is the premium in whole life than in the universal life? Well, it's not double, but it's pretty significant difference. And so when smart insurance buyers understood that they could buy the same $1 million policy for $20,000 a year of premium in the whole life, or $10,000 of premium in the universal life, they said, well, why wouldn't I pay the $10,000? You're saving $10,000 a year for the same amount of face value. Well, if you've got somebody that's very wealthy that says, why would I want to tie up an extra $10,000 into my whole life policy when I can buy the universal life for 10? What's my risk? And the risk is that if the crediting rate that we assumed on the $10,000 falls below what was used to build the policy, you're going to have to come up with more money. So you might have to put in another $15,000, $20,000 20 years from now to get back on track to what it was that we originally estimated. And the buyers say, well, why wouldn't I do that? Makes all sorts of sense. If I can take that $10,000 and buy universal life and invest the difference, why wouldn't I invest that difference and be at risk for whatever the delta is between the whole life and the universal life? And that simply is the difference. Okay, there is really no difference between the two products other than the fact that the premium is set with universal life, based on the crediting rate, whereas whole life, it's based on the guaranteed rate. Okay, so it's your choice. If you want to pay more premium and have a guaranteed premium and never have to worry about whether or not you have to come up with more money, whole life is a great choice. If you're more adventuresome and better able to manage your money and would rather not give the insurance company that extra delta, then you're going to want universal life. So does that make sense, the difference between those two?
For sure. Yeah. Whenever I'm talking to clients, I normally say that whole life isn't grandpa's insurance, but it's more of grandpa's insurance because it's fixed. It's a little more costly because if you have fixed guarantees, it's going to cost you a little bit more. Versus in the universal life, on the front end, it's going to be cheaper. On the back end, it's going to be more expensive. But like you said, if we can invest that delta now, it makes more sense. So the flexibility in the IUL I like more, but we still sell a lot of whole life policies. And another thing is, another argument is you can pay up whole life, but you can't pay up universal life. So what are your thoughts on that?
Well, it depends on how you define the word paid up. Okay. With whole life, you're guaranteed paid up. When you reach a certain level with the guaranteed, cash value crediting rate that's within the policy, for sure you never are going to have to ever put any more money into that. But the cash values to do that, let's say at age 50, might be $350,000. Okay, because that's based on a 2.5% or 3% crediting rate. With a universal life policy to be paid up, okay, and I'm going to correct this in a second. Maybe you only have to have 250,000 or 225,000. So you can tie up 125,000 less dollars in the universal life policy to be paid up than in the whole life. But then, the critics will say, yeah, but it's not guaranteed at that point in time. And that's absolutely true. It's paid up mathematically, but if the policy doesn't perform going forward at the same level as the assumptions were, then you're going to have to come in with more money. But again, it's that same argument. Can I do better with my $125,000 in alternative investments and be at risk for having to put in another 25 or 30,000 10, 15, 20 years from now? Or am I better off? Is my peace of mind more secure knowing I'm totally paid up at 350 and I'm never ever going to have to worry about it? So which is better, an apple or an orange?
That's it. That's it.
That's really what it is.
Yeah, you brought up buy-sell agreements, and I do have some clients that say, what is a buy-sell agreement or what is an executive bonus program? So whenever you set those up, I guess just kind of explain what they are and what type of products you use to set those up and why.
So one of the very interesting issues between whole life and universal life is what happens if you can't pay the premium, and what if you want money out, okay? And so with a whole life product, if you can't pay the premium, the policy will lapse. So what they'll do is they'll borrow money from the cash values in order to be able to pay the premium. And then they're going to add interest to that cost, which will reduce your cash values even more. And then over a long period of time, if you don't keep paying those premiums and stay on top of that interest, the policy could lapse. So, just because it's whole life doesn't mean it can't lapse. With universal life, you don't have that problem. If you can't pay the premium, what they'll do is they'll take the mortality cost, the term insurance cost out of the cash value. There's no loan and there's no interest costs on doing that. You run into the same problem if the box, the cash value box runs out of money, the policy will crash. But it's easy to restore that money both with a whole life policy and with a universal life policy. So again, they're exactly the same. So what we've found with buy-sell agreements is that there's two things about buy-sell agreements that are important to understand. Number one is you have them in place because if one of the owners dies, the other owner wants to have enough money to be able to take control of the stock, own the company, and buy out the surviving shareholders' family or the deceased shareholders' family, right? So that's a good thing because if your share of the business is $2 million and my share is $2 million, something happens to you, I want to buy out your wife. I want to own that business free and clear. I don't want to be in partnership with, the spouse. And so a buy-sell agreement makes all sorts of sense, not only from that standpoint, but from the standpoint of disability, divorce, illness. There are all sorts of factors that can come into play that can disrupt the ownership of a business that need to be thought about ahead of time and put a contingency plan into place. But the facts of the matter are that less than 10% of all buy-sell agreements result in a death. Okay. But what's far more likely to happen is the people are going to live to retirement and they've got these life insurance policies. And what are you going to do? Are you going to cancel them? Are you going to keep them? Are you going to transfer them among each other? So if you've got permanent insurance, and I'm saying whole life and universal life and IUL are all permanent insurance. If you've got permanent insurance in place and there's large amounts of cash values, those cash values can then be used to offset the value of the stock. And so if you're entitled to 2 million and we've got $1 million in cash values, I can buy you out by giving you that policy with $1 million of cash values, and then only have to come up with another $1 million in addition to that to buy you out. Whereas if we funded it with term insurance, then I'd have to come up with the full 2 million. So there's your buy, sell, and invest the difference, right? Good luck on having that 2 million bucks. So anyway, the point being that businesses get into trouble from time to time. They have cash flow issues. So if you've got whole life, then you've got to struggle with that issue of borrowing and interest and all that stuff. If you've got universal life, then you only have to deal with the mortality costs, and it's all done automatically within the policy, and you don't have a lot of administration issues to have to deal with in order to move through the downturn. So one thing I want to get back to though before we look at maybe alternative uses of insurance is that I just was speaking of UL, all right, universal life. And the crediting rate on universal life and the crediting rate on whole life are exactly the same. Okay. I mean, there are a lot of insurance companies that offer whole life and universal life. And if you look at them, they're crediting the same amount. With the whole life, the delta between the guaranteed rate and the earnings is dividends. With the universal life, you get the full crediting into the policy. Okay. So if I want greater returns, then we have to take greater risk. And to take greater risk, the insurance company created this incredibly, it's a fantastic product, I think, universal life with indexes. And so what happened there was they took the guaranteed interest that the insurance company said they were going to pay in the universal life chassis, and they bought puts and calls, options on the index. So let's say it's the S&P. So if you were to lock in the S&P at $1 and it went to $2 with the options, you got the gain. Okay, and that's called in the money. But if the interest bought the options and the options were worth $1, same value or less at the end of the crediting period, which is usually 1 year, okay, then you're out of the money and you don't get anything. So you lost the interest that bought the options. And so that year, your policy actually degraded a little bit. It didn't perform at anywhere near what was illustrated. So the question then is, how often are you going to be in the money versus out of the money? And the S&P, if you look at it, historically over the last 100 years, 75% of the time it's been in the money. So if you've got a 25% downside and a 75% upside, will the upside be enough to make up the difference? And there are some ways to be able to mitigate that, get multipliers. I mean, there's a lot of creativity that takes place in that, where the universal life policy can really perform at an exceptional level, but it could also perform very poorly. So, but again, that's the apples and oranges thing that we talked about. If you want guarantees, you buy apples. If you like messy fruit and get juice all over you, you buy oranges. And universal life is an orange. So an index universal life just adds another level of risk to it.
Gotcha. Well, if there's any agents watching this and they want to know more about an index universal life policy, it's kind of complicated. They say it's one of the most complicated products on the market. Can you dumb it down? I know you already talked about the options and how that works, but an index universal life in its most basic sense, how would you explain it to someone who doesn't know what it is?
In its basic sense, once they understand the box and the cash values, the box is going to earn interest. The interest is going to buy options on the stock market. You're never at risk. Your money's guaranteed inside the box, so you can never lose it. All that can happen with the stock market is it's going to go up or it's going to go down. If it's going to go up, then you participate in that gain. If it goes down, it's a zero.
Gotcha.
And so they've got to credit interest to the box every year, and that's an alternative method.
There's one more thing: infinite banking, banking on yourself, becoming your own banker. I'm sure you've heard of them all, every little catchphrase there is. A lot of people say that whole life is the only way. Some people say that IUL is better. I know personally, I think it's, like you said, which flavor, apple or orange. How have you used index universal life, whole life, or any kind of life insurance policies to accomplish that for your clients?
So when you've been in the business almost 60 years, you've seen it all. But not only have you seen it all, but you've seen it all packaged and branded in different ways. So, infinite banking is a wonderful marketing concept. It's a great way to talk about the benefits of cash value in a permanent life insurance policy, but it's nothing new. Okay, infinite banking existed, in the late 1800s when you had cash values in a policy. So we're not talking about a brand new concept here. We're talking about how to utilize cash in a policy if you've been successful in accumulating cash over a period of time. All right. So I just think it's important to understand this is not a new concept. Now, having said that, if the idea of the life insurance policy is to be a source of money that you can tap in to buy a car instead of going to your favorite credit union or bank or dealership to buy it, why not? You borrow out $50,000 and make your payments to your life insurance policy, restore the cash values, and you own the car and you've got your money back, and the bank or the credit union or the dealership lost because they didn't get that money. And what a wonderful thing. What's the difference between that and having $50,000 in your savings account, and you borrow it out and you pay cash, and then you restore the $50,000 back to your savings account? I mean, there's no difference between it, except that with the life insurance, you've got the death benefit, but you've also got the mortality costs and the expenses. So I'm not denigrating it at all. I'm just saying, let's be practical about this. So are you better off having your money in a whole life policy, or are you better off having it in a UL? Well, we already know, if anybody's been actually listening, there's no differences between them, right? The whole life policy has a little bit more in the way of guarantees, but you pay for it. So if you feel like the guarantees make more sense in the infinite banking world, then use whole life. If you don't care about that and you'd like to see your money grow at a higher potential rate of return using the index crediting rates, then use the universal IUL. So, apples and oranges.
Right.
There's no difference.
Well, I know we talked about insurance only, and in the future, I'd like to get you on to talk about planning and how you kind of manage money and everything. But there is one last question on the infinite banking frontier. There's a guy, won't say his name, that says that you can put your life insurance policy in an irrevocable trust, a complex, spendthrift, non-grantor, blah, blah, blah trust, and you never have to pay taxes, even if you make a modified endowment contract. I don't know if you've heard this before, but I'm sure there's just bells and whistles going off in your head like, no, wrong. So, like, what's your thoughts on people saying that if you make this crazy trust and you put it in a dynasty trust that lasts forever and you push the taxes down the road forever, you never have to pay taxes on a modified endowment contract, on any growth, anything like that?
Well, the only way, so there's a lot of issues going on in the way you've described that. And, if you've described it accurately, there's some problems with it, I believe. Um, you know, Anybody that's going to market that concept probably has done a lot of research, and there's some caveats in their opinion letter that spell out how they're avoiding some of this. So you'd have to look at all of that. But having said that, the tax principles are simple, okay? Trusts are not tax-free, okay? Roth IRAs are, IRAs are, 401ks are tax-free, but a trust, even a dynasty trust, is not tax-free from income taxes. Somebody's going to pay the tax. Either the trust is going to pay the tax or the beneficiaries are going to pay the tax. Or maybe the grantor, depending on how it's set up. So if you're going to put a life insurance policy inside a trust, and you're going to make it a MEC, and then you're going to create MEC taxation, I can't conceive of any way that you would ever avoid that, unless it was a tax deferred trust, which would about the only one that could possibly do that would be a Roth. Maybe they've got some type of a Roth strategy built into this in some way, shape, or form. So, it's whenever you get into some of these more esoteric strategies, the first thing you want to do is look at the facts. Okay. And so, show me the opinion letter that breaks this all out, that has all the tax ramifications and code sections that allow you to be able to do this. That's usually where these things fall apart immediately. And I've had a lot of, we do a lot of tax strategies where, we work with attorneys and accountants. And one of the questions we always ask the attorney and the accountant who may be negative about what we're talking about is that your opinion or is that a tax fact? Because most of the time it's an opinion. And when they dig into it and they really look at the tax facts, they find out that our program works exactly the way we say it works and the way we've documented it. So just turn the tables, in that situation and just say, is that your opinion that this is going to be tax-free, or is it a tax fact? And if it's a tax fact, show me the code sections and how that works. I can't imagine that they could do that with the way you described it.
No, not at all. Okay, well, the last thing I want to touch on is estate planning. How do you use life insurance for estate planning?
So again, it's all in the definitions, right? What is estate planning? So for some people, estate planning is, dotting all the I's, crossing all the T's, and making sure that when you die, which, last time I checked the actuarial tables, it's 100%, right? Everything's going to go smoothly. You're not going to get tied up in probate. There's not going to be a lot of delays passing the assets over to the family. You've got your health protectives in place, the powers of, all that stuff. So that's estate planning 101. All right. But if you've got wealth and you have been successful in accumulating assets, then the question is, are you above the line or below the line? And the line is the estate tax exemption. So right now that line's at like $24 million. If you're married, 12, 13 million if you're single. That's scheduled in at the end of 2025 to drop down to like 6 or 8 million and 12 million, 12, 13 million. Well, that's a huge opportunity. for anybody, because you've got 12 to $13 million of a state tax exemption that's going to disappear when we cross over that line in 2025. So why not lock that in today? Now, I understand this isn't a life insurance strategy that we're talking about, but it just makes good common sense. So inside of those trusts, then the assets grow just like they're growing today. But all of the appreciation is exempt from taxes. The basis is whatever the asset was when you put it in. So if you get, you may not get a step up in basis depending on how that's all been designed. So if you don't get a step up in basis and the family wants to sell those assets, what better way is there to pay the income taxes on that than to have a life insurance policy payable to the trust that can fund the income taxes? If you've got an estate greater than the $25 million cap, and soon to be 12 million or 13 million, then 40 to 45% of all the assets that you own over and above that exemption will go to taxes. The government has a lien. But I learned many, many years ago, and I can't think of George's last name, but he wrote a book that was called something to the effect that the estate taxes were optional. And when I read that, I said, now that's a book I want to study. And sure enough, as I read that book and we applied those principles, we found out that nobody has to pay estate taxes if they're willing to do the planning and strategic thinking that's required ahead of time. So where does life insurance come in? Well, life insurance can be used at the very simplest in 102 and 103 just to pay income taxes and estate taxes, but it can also be used to equalize between heirs. Johnny owns the business, and Susie and Karen, are exempt from the business, and Johnny's made that business worth $100 million, and Susie and Karen get $10 million each because they weren't participants in that. And Dad says, well, that wasn't exactly fair. I'm going to give them another 10 million of life insurance each, and the company's going to pay for it. And if they use our method, we'll deduct the cost of that, which is something that most people don't know they can do, is deduct the cost of insurance. So
don't get me started there.
Yeah, that's estate planning 101, 102, and 103.
Gotcha. Well, the very, very last thing I want to ask you is, do you believe that one of the best ways, if not the best way, to create generational wealth is to take out permanent life insurance on kids and family members? That way you can recycle your wealth and exponentially grow between heirs and generations.
So let's break that down. Okay. If you've got a very wealthy family worth 50 million, 100 million plus, right? And we know the heirs are going to receive substantial dollars, they're going to have to invest those dollars, or maybe they're already receiving those dollars that have to be invested. I'm thinking of a family in the Midwest, where they've already started to divvy up the money, and some of those kids that are 15, 18, 20 years old are worth 20 million, 30 million, 50 million today, right? So it has to be invested. Well, where are you going to invest it? Well, they're going to invest it in real estate. They're going to invest it in the stock market, maybe. They're going to invest it into precious metals. There's all sorts of ways to invest that money. Well, we've already seen life insurance is an alternate asset class. So if you can buy a life insurance policy, fund it up to the MEC level, and have that policy grow using stock market returns tax-free over a long period of time, you can create a life insurance policy, cash values that are exempt from taxes, that's for future generations, that is available anytime they need it, if they have to go to the bank, the infinite bank, to get the money, right? And that asset could be worth more than all the rest of the assets combined. So, compound interest is a miracle. I think it was Benjamin Franklin that said it was the, ninth wonder of the world. But if you don't understand compound interest and you don't apply it and take advantage of it, then there's no value to it at all.
Right. Well, this went very well. There's a lot of nuggets in here. If people didn't learn anything, in this almost hour call. They're well, a whole lot smarter than I am. So I want to get you on for like a second, third, fourth, fifth. I want to just unload as much as you will allow me to let you unload. I want to talk about, the tips we talked about the other day. I thought that was huge, how you manage money, what people could look out for in, the financial realm, just about everything. So as long as you're okay with being back on, I'd like to have you back on.
Hey, you can tell I love to talk.
That's great. All right. Well, guys, there'll be a link in the bio for the book. Any credentials that he has, we're going to put them on there that he's comfortable putting on. We'll put the wealth advisory group on there so they can kind of go check your background, everything like that. Besides that, look out for episode 4.
Great. Well, thank you for having me.